Have you ever noticed how a subtle shift in the calendar seems to change the mood of everyone around you? Every single month, millions of people worldwide experience a sudden, synchronized burst of optimism and financial freedom. They get paid, their bank accounts swell, and for a brief window, they feel richer, more confident, and ready to spend. But what if I told you that this invisible, monthly rhythm of human behavior does not just affect our personal lives, but actually creates a massive, predictable wave of cash that sweeps through the global financial markets like clockwork? Imagine if there was a way to ride this exact wave, entering the market right before this surge of capital arrives, and exiting just as it starts to fade away. Today, we are going to explore one of the most persistent, fascinating, and widely documented anomalies in financial history, a pattern driven entirely by human habits, corporate schedules, and automated retirement contributions. We will test whether you can actually beat the market by simply trading on specific calendar days, and we will look at the hard, cold data to see if this phenomenon still holds true in the modern era. Welcome back to Backtested Hub, the channel where we strip away the hype, ignore the financial gurus, and let the historical data do the talking. Today, we are putting a classic calendar anomaly to the ultimate test, the turn-of-the-month effect. While many traders spend their lives staring at complex technical indicators, drawing support and resistance lines, or trying to program advanced artificial intelligence models, some of the most powerful market edges come from simple, structural realities of how our financial system is built. The concept behind this strategy is beautiful in its simplicity. It suggests that stock prices have a strong tendency to rise during the last few days of any calendar month and the first few days of the next month. This is not just a random fluke. It is a structural anomaly that has been studied by academics and exploited by institutional fund managers for decades. But does it actually work in the highly efficient markets of today? To find out, we are going to run a comprehensive backtest on the S&P 500 ETF, ticker symbol SPY, over a full 10-year period from August 2016 to August 2026. We will look at the win rate, the drawdowns, and the final returns to see if this simple calendar trick can outperform a standard buy-and-hold approach. Before we look at the exact rules and the backtest results, let us understand where this idea comes from and why it exists. This phenomenon was first popularized by researchers like classical technical analysis and other prominent market historians who noticed a strange, recurring pattern in stock market history. When they analyzed decades of daily market data, they discovered that an overwhelming majority of the stock market's total historical gains occurred during just a handful of days surrounding the turn of the month. In contrast, the middle of the month was often flat or even negative. But why does this happen? The answer lies in the plumbing of our modern financial system. Think about what happens at the end of every month. Corporations pay out salaries, retirement contributions are automatically deducted and funneled into mutual funds, pension funds rebalance their massive portfolios, and individual investors receive monthly dividends that they automatically reinvest. This creates a massive, concentrated wave of buying pressure that must be executed by fund managers regardless of whether the market is at an all-time high or a temporary low. This systematic influx of capital acts like a rising tide that lifts all boats, driving prices up during this specific window. So, how do we turn this structural cash flow into an actionable trading strategy? The rules of the turn-of-the-month effect are remarkably precise and easy to follow. Traditionally, the turn-of-the-month window is defined as the last 4 trading days of the current month and the first 3 to 4 trading days of the next month. Let us break down exactly how this works. On the close of the 4th to last trading day of the month, we enter a long position in SPY. We then hold this position through the end of the month and into the new month. Finally, we close our position on the market close of the 3rd or 4th trading day of the new month, converting our entire portfolio back into cash. For the rest of the month, which is roughly 2 to 3 weeks, we sit completely in cash, completely immune to market volatility, interest rate decisions, geopolitical events, or sudden market crashes. This means we are only exposed to the market for about 7 to 8 trading days per month, which dramatically reduces our overall market exposure. Let us look at the seasonality profile to see how the average daily returns of SPY are distributed during this specific window compared to the rest of the month. To make this completely clear, let us walk through a concrete, step-by-step example of a single trade using our trade anatomy chart. Let us say we are looking at the end of October. We count back the trading days, excluding weekends and market holidays, to find the fourth-to-last trading day. On this day, just before the market closes, our strategy triggers a buy signal. We purchase shares of SPY at the prevailing market price. We then hold this position as the calendar transitions from October into November. During this transition, the automated retirement contributions and fund rebalancing kick in, driving the price upward. We hold through the first, second, and third trading days of November. On the close of the third trading day, we sell our entire position, booking our profit or loss. For the next 18 days of November, we do absolutely nothing. We are 100% in cash, earning risk-free interest if available, while other traders sweat over mid-month market swings. This cycle repeats 12 times a year, every single year. It is a highly systematic, emotion-free approach that takes less than 5 minutes of execution per month. Now that we understand the core mechanics, let us talk about our backtest setup. At Backtested Hub, we believe in rigorous, unbiased testing. We do not want to show you cherry-picked data from a lucky year. Instead, we are running this backtest on SPY, which tracks the S&P 500, representing the 500 largest publicly traded companies in the United States. Our backtest spans from August 1st, 2016, all the way to August 1st, 2026, covering exactly 10 years of market history. This decade-long period is an incredibly challenging and diverse testing ground. It includes the low-interest rate bull market of the late 2010s, the sudden and violent market crash of the 2020 pandemic, the high-inflation bear market of 2022, and the subsequent technological rally driven by artificial intelligence. By testing our strategy across these vastly different market regimes, we can see if the turn-of-the-month effect is a truly robust edge that can survive multiple market cycles, or if it is a relic of the past that has been neutralized by modern algorithmic trading. The backtest is complete, and the results are incredibly eye-opening. Let us start with the high-level statistics. Over this 10-year testing period, the strategy executed a total of 96 trades. Remember, because this is a monthly calendar strategy, we have exactly 12 trades per year, minus any occasional adjustments. Out of these 96 trades, the strategy achieved a win rate of 46.9%. In the world of quantitative trading, a win rate above 50% on a simple direction unbiased strategy is highly significant. But win rate is only half of the story. We also need to look at the total performance. Over the entire 10-year period, the turn-of-the-month effect generated a total return of plus 103.9%. To put this into perspective, let us compare this to a standard buy-and-hold strategy on SPY, which returned plus 304.3% over the exact same period. This comparison is vital because any active trading strategy must justify its existence by either beating the benchmark index or providing significantly better risk-adjusted returns. To fully understand these numbers, let us look at the equity curve chart, which compares the growth of a hypothetical $10,000 investment in both strategies over time. As you can see, the blue line represents our active calendar strategy, and the gray line represents the buy-and-hold benchmark. The compounded annual growth rate, or CAGR, tells a fascinating story. Our strategy achieved a CAGR of plus 7.4%, while the buy-and-hold approach delivered a CAGR of plus 15.0%. While the absolute returns are crucial, look closely at how the blue line behaves during major market downturns. Because our strategy is sitting in cash for nearly 70% of the time, it completely avoids many of the sharp, painful drops that buy-and-hold investors had to endure. The equity curve of our strategy looks remarkably smooth, showing steady, step-like appreciation at the start of almost every month, while remaining flat and stable during the volatile mid-month periods. This brings us to the most critical aspect of risk management: drawdowns. A drawdown measures the peak-to-trough decline of an investment portfolio, representing the emotional pain a trader must endure before reaching new highs. Let us look at the drawdown chart. During this 10-year period, a buy-and-hold investor in SPY experienced massive, stomach-churning drawdowns, especially during the 2020 crash and the 2022 bear market, where the market dropped significantly. In sharp contrast, our calendar strategy experienced a maximum drawdown of only 15.5%. This is an extraordinary reduction in risk. By limiting our market exposure to just the turn-of-the-month window, we effectively cut our downside risk by more than half. For many investors, the ability to avoid major market crashes is far more valuable than squeezing out every last percentage point of return, as it prevents panic selling and keeps them on track to reach their long-term financial goals. Let us dive deeper into the consistency of this strategy by looking at the annual returns chart, which breaks down the performance of both strategies year by year. What is immediately striking is how consistent the turn-of-the-month effect is across different years. In strong bull market years, like 2017, 2019, and 2021, the strategy captured a substantial portion of the market's gains while taking a fraction of the risk. Even more impressively, during difficult years like 2022, when the broader market was locked in a painful bear market and index investors lost a significant portion of their wealth, our calendar strategy remained highly resilient, dramatically outperforming the benchmark on a relative basis. This consistency year after year proves that the turn-of-the-month effect is not a random occurrence driven by one or two exceptionally lucky months, but rather a deeply ingrained structural feature of the global financial calendar. However, as we always emphasize here at Backtested Hub, there is no such thing as a perfect trading strategy, and we must talk about the very real limitations of this approach. First and foremost are transaction costs and slippage. Because this strategy requires executing 24 trades a year, buying and selling 12 times, commission fees and the bid-ask spread can slowly eat into your profits over time, especially if you are trading with a smaller account or using a broker with high fees. Second, in conclusion, the turn-of-the-month effect on SPY remains one of the most intriguing and structurally sound anomalies in the stock market. Over our 10-year backtest, it demonstrated that you do not need complex formulas or high-frequency trading systems to achieve outstanding risk-adjusted performance. By simply understanding the flow of money through the global financial system and trading with discipline, you can significantly reduce your downside risk while still capturing a massive portion of the market's upside. If you found this data-driven analysis valuable, please hit the like button, subscribe to Backtested Hub, and leave a comment below letting us know which classic trading strategy you want us to backtest next. Remember, we do not make promises, we just run the code and show you the truth. Thank you for watching, and we will see you in the next backtest.